We're back with one of our favorite formats, what we call a shorty episode, in which in 10 minutes or less, we take a term used in the cross-border space and we give you, a high-level definition of what it is, of course, with the intention that we'll come back to it and talk about it in more details in future, because unfortunately, most of these topics tend to be rather complex. So in today's episode, we're going to answer a very specific question. We want to answer the question, what is a gift tax and how does that differ from an estate tax? So, Manasa, you want to jump into this right away?
Yes. So a gift tax is on a gift. There is an estate tax, which is on the estate. Well, one major difference between the two is a gift is made during the lifetime of a person gifting, whereas the estate is after the person has passed away. So a gift tax is whatever's taxable after the annual exclusion, and an estate tax is taxable after taking the lifetime exclusion on the estate. So basically, 20,000 feet view of what is a gift tax and what is an estate tax. You want to go more into that, Jane?
Yeah, so what I like is when we talk about a gift tax in the US IRS code, a gift tax is paid by the giftor, the person who is gifting, right? Whereas in other countries, it tends to be the opposite. So we're just going to stick with the US for now. And then, of course, the estate tax is on the estate. And if the estate owes some taxes, that has to be paid before the assets can be distributed to the beneficiary. So, in terms of when I think of a gift tax and where this applies to us, you have what's called an annual exclusion. In 2025, the annual exclusion is, I think, about 19,000. So it's pegged to inflation, which means you can give anybody, they don't have to be related to you, up to 19,000 and not have to worry about paying gift taxes on that. If it goes beyond the 19,000, you are liable to pay a gift tax on it. But what happens, and this is where now we talk about the lifetime exclusion, you basically just need to file a gift tax return, but there's really no gift taxes owed on it because that gets carried forward to your final estate taxes. There's that whole thing, the unified credit. You know what I'm talking about, Manasa?
Of the unified tax credit. So, if you go look at the definition of the unified tax credit, basically that is the IRS's transfer tax unified, which means it combines two separate lifetime exemptions, or rather, lifetime tax exemptions for gifts and estate taxes. And this combined exemption limit then applies to all taxable gifts you make to others during your lifetime and assets you leave to your beneficiaries through your estate.
Which is a great explanation. So, as long as this is now where, of course, it starts getting a little tricky, as long as you're a US resident, tax resident, so think like a citizen, green card holder, you're in the US, you are able to avail yourself of this 19,000 that applies to everybody, as well as the lifetime exclusion of about 14-ish million. Well, up until this year, we'll see what happens with the tax code. So it really means if your assets are around 14 million and you pass away this year, you'll probably be able to gift away the people inheriting your money, they'll be able to get it without having to pay estate taxes on it. Again, this is a very simplified view. Now, the main difference, and this is why we wanted to talk about this, is if you're an NRA, right?
Yes.
And you have
Yes.
what's called US citus assets. This is stuff that's in the US. Your exemption is not 13 ish million, your exemption is only 60 million a death. So what
You
this
mean
means,
60,000?
yes, I'm sorry, 60,000.
60,000.
Yes, I think that was just wishful thinking, 60,000.
Yeah.
And that number has been 60,000, I think, for as long as we can go back. It hasn't
Yeah.
changed.
Hmm.
Probably because there hasn't been anybody pushing it in the US system to change it. But that's a topic for another day. So 60,000, what this means is if you pass away and there's a whole process they'll use to figure out that you're an NRA, you're not domiciled in the US, you have US situs assets, you get the 60K exemption. And then if you have more than 60K, your estate is going to have to pay estate taxes on this, which could be up to 40%. Anything you want to add to that?
Kind of hard to come in after that, Jane. But yeah, the big thing here is, the planning part of it, right? Which, being a shorty, we won't go into this, but the importance of planning, and then the importance of kind of having a big picture in mind as far as where you might be, where your children might be, or your beneficiaries might be, and taking into consideration what your total lifetime exclusion would be and how you're going to structure all that. So that's definitely a big plan that should be done, definitely earlier than later, I think. And yeah, that's more or less what I would like to add at this
And, and
point.
and actually, to your point, that number is really scary. Think about
Yes.
you own a house, and let's
Mm-hmm.
say the house is worth 1 million, and you get
Mm-hmm.
an exemption of only 60K, which basically means your family almost has to sell the house to be able to
Yeah.
pay the 40% taxes. But to your point, with very careful planning, you can
Mm-hmm.
actually avoid this number. The key thing in today's episode is we just want to introduce this so you're aware of it. And then
Yes.
understand how IRS looks at it. So start understanding what's called domicile. What planning can we do to help you get around this? So all is not lost. There's hope for you. But if you don't plan, this could be an issue if you're NRA. Anything else you want to add?
One thing, just so people would know, that where we are talking about the $13.99 million in lifetime exemption, know that that is supposed to sunset at the end of 2025. And as of January 1st of 2026, all of those numbers will go back to what they were before 2018. That number was much less. It was $5 million. And if you are a non-resident alien who is here in the US and you live on the West Coast and work for one of the big tech companies, it's really quickly adding up to that $5 million, most likely if you have RSUs and a house in California, let's say. So again, coming back to the planning part of it. So yes, and we'll I think we need to address the rest of it on a different
Yes, yes.
episode,
We,
right,
we, we
Jane?
probably need to talk
Yes.
about the planning that we can do, or what
Yes.
are some of the things you can do to kind of avoid this. Absolutely. This is just
Yeah.
an intro. Yeah.
Yeah, for sure. So, dear listener, thank you for being here. And we love to bring you these shorties where we can introduce you to these ideas of all of the legalese that is around foreign tax or any tax planning and other stuff that you need to know about. So, thanks for stopping by. Take care. Bye.